Hello and welcome to AI Market News by LMT. This week we're diving into an economy that seems to be telling two completely different stories at the same time. On one hand, we've got data flashing some serious warning signs of a slowdown, but on the other, inflation is just sticking around. So, what's the real deal? Let's get into it.
So, that's the big question on everyone's mind, isn't it? Is the US economy finally hitting the brakes, or is stubborn inflation still the headline act? The latest numbers from the first week of December make a really strong case for both sides, and that's exactly what we're going to unpack today.
All right, first up, we have a genuine shocker from the US labor market. I mean, this was the number that caught pretty much everyone off guard, and it really shifted the conversation about the economy's momentum, and fast.
And here it is, the number that sent a bit of a shockwave through the markets. The ADP report, which keeps tabs on private payrolls, showed a loss of 32,000 jobs. Now, to put that into perspective, analysts were actually expecting a gain. So this isn't just a miss, it's a complete U-turn from the 47,000 jobs that were added just the month before.
But, that big headline number doesn't really tell the whole story. When we dig into the breakdown, we see this clear split. Sectors like professional services and manufacturing, well, they shed tens of thousands of jobs. But at the exact same time, education, health, and hospitality are still hiring. It's like we're looking at a two-track labor market, and that difference is absolutely critical.
Now, you'd think a cooling labor market would mean cooling inflation, right? Well, not so fast. When we widen our lens and look at the global picture, things get a whole lot more complicated. This really paints the picture of the global headache for central banks. Over in the US, the Fed's favorite inflation number, that's the core PCE, which strips out the bouncy food and energy prices, is still stuck up at a pretty high 2.8%. Meanwhile, in Europe, the main headline number looks lower at 2.2%, but it's actually ticking up, moving in the wrong direction. So yeah, nobody's taking a victory lap just yet.
And if we dig into that European data, one thing really jumps out: services. Prices for services popped up to 3.5%, and that's the real problem area. See, services inflation is usually stickier because it's so closely tied to wages, and that makes it a much tougher nut for the European Central Bank to crack.
So this idea of a divided economy, it comes into even sharper focus when we check out the latest business activity reports. The ISM's Purchasing Managers Index, or PMI, gives us a real-time pulse on the health of both manufacturing and services. And believe me, they are telling two completely different stories.
Wow, you couldn't ask for a clear picture of this split. On the left, we've got the manufacturing PMI sitting at 48.2. Remember, anything below 50 means things are contracting. And this is the 9th straight month of decline for that sector. But then look at the right. The services sector, which is way bigger, is still in expansion mode at 52.6. It's like we're watching two different economies operating at the same time.
And this isn't just some abstract number on a chart. This quote from someone in the chemical products industry gives us a voice right from the factory floor. They're pointing to tariffs and just general uncertainty as the reasons demand is getting weaker. These are the real-world pressures that are behind that contracting PMI number.
Okay, so let's break this down even more. New orders, yep, same split, shrinking for manufacturing, growing for services. But here's the really key part. Employment is contracting in both sectors. This just backs up what we saw in that surprise ADP report. And this is crucial for the inflation fight. Businesses in both manufacturing and services are reporting they're paying higher prices. So those cost pressures are definitely not going away.
So what do you get when you mix a shocking drop in jobs with stubborn inflation and a split-screen economy? Well, you get a giant headache for the Federal Reserve. All of this conflicting data just puts a massive spotlight on their next big policy meeting.
And this is exactly why the upcoming FOMC meeting is probably the biggest market event of the entire month. The Fed is really caught between a rock and a hard place. Do they focus on the clear weakness in jobs and manufacturing, or on the sticky inflation and the strong services sector? How they read these tea leaves is going to set the direction for everything from the S&P 500 to the value of the dollar against the euro and the yen.
So let's get our calendars out. According to the schedule from investing.com, Wednesday, December 10th is the day. At 1 p.m. Eastern Time, we get this triple header: the Fed's economic projections, their official statement, and of course the interest rates decision. But honestly, the main event often kicks off 30 minutes later at the press conference. That's when every single word from the Fed chair will be picked apart for clues about what's coming next.
And it all just boils down to this one question: Will that weak jobs report be enough to make the Fed signal they're pausing, or maybe even hint at cuts down the road? Or will that stubborn inflation data force their hand and keep the possibility of one more rate hike alive? The answer is almost certainly going to set the tone for the markets for the rest of the year.
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks for watching. If you found this breakdown useful, don't forget to like and subscribe.